welcome to a new virtual investment summit by Fund Society. Today is the last virtual investment summit of the year, and we have the pleasure to welcome our audience from Latin America, United States, and also from Spain. Así que bienvenidos los que estáis en España. A couple of housekeeping instructions. First of all, to those who are listening from Spain, I want to let you know that this session will be available for certification in EFPA through a test that will be posted in the web of EFPA after the session is over. And also, I would like to remind you that after the panel, there will be a Q&A session, and you can post your questions throughout the duration of the session through the WebEx app in the Q&A button, or sending an email to info@fundsociety.com. And now I would like to introduce our guests today. We're talking about Asia. We're talking about the Year of the Tiger 2022 and in the investment outlook, and we're doing so with Eastspring Investments. And we have Matthew Applestein with us. He's head of the Americas in Eastspring Investments. So Matthew, welcome, and please go ahead with the show.
Thank you, Alicia, and thank you all for joining us today. I'm Matthew Applestein. I head the Americas for Eastspring Investments. We're a $250 billion asset management firm headquartered in Singapore, with one of the largest on-the-ground presence of any asset management firm in the world. And about 2.5 years ago, we decided to leverage that Asian expertise and started an Asian Expert Series. Today is a continuation of that with our Asian Expert Series webinar, where we're going to talk about what's going on in the market today, but more importantly, our outlook and views for 2022. And we'll drill down in two areas of the marketplace: the fixed income marketplace in Asia, which today has some of the highest yields in the world. And then we're also going to drill into the equity marketplace and look at the value opportunities that are being created by some of the dispersion between growth and value. Today, joining me is three of our subject matter experts from Singapore: Adam Matthews, who runs our client portfolio management team; Tricia Wong, who will talk about the fixed income area; and Sam Bentley, who will talk about the equity area. Adam's going to be moderating that panel, so we're going to make this very interactive. And again, it's critical, please feel free to ask questions. And even more important, if we're not able to answer the questions today and you have follow-on questions, please feel free to reach out. That Asian expertise is something we're really proud of, that we feel with our presence in all the countries in Asia, that we can help you if questions come up, and will be available after the call today. So let me finalize this by saying thank you, Fund Society, for working with us. They're a great partner. We look forward to continuing to working with them in 2022. And with that, I'd like to turn it over to Adam to take us through Eastspring's views on the Asian marketplace. Thank you, Adam.
Thanks very much for the introduction, Matthew, and thank you to everyone for joining us on today's webinar. I'm Adam Matthews. I'm head of client portfolio management. I have two colleagues with me. We're all based in Singapore, so we're delivering our views right from the mouth of Asia, so to speak, today. I'm going to spend about 15 minutes covering a high-level review of the Asian markets and give you an idea of what we're looking out for in 2022. I'm then going to turn over to my colleague, Tricia Wong, who will cover Asia fixed income, and with a particular focus on Chinese fixed income market, because that's been, again, an area that Matthew alluded to of quite significant dispersion of returns, and some very hot areas and some very cold areas. That we're then going to talk to Sam Bentley, and he's going to cover global emerging markets, and especially the outlook for value in GEM, and a new phenomenon which is emerging within the emerging markets of potentially carving China out of the global emerging markets universe for a GEM X China mandate. But let's first start with a recap of what we said earlier last year. So I'm going to start on slide 2. That's the next slide, please. And in March of 2021, this year, we said that while equity valuations were high, we remained positive on equities over bonds. We felt that the momentum behind economic reopening and the tailwinds of the fiscal and monetary stimulus were really strong enough to carry that bull market longer. And I think that assessment was correct. We felt that we would see a growth pattern shifting from a US-led pattern of growth, probably to something in the rest of the world, in particular in the Asian region. That call was early, and that call was not correct for 2020. As Asia continued to lag the US and Europe in economic reopening and in stock market returns. We felt valuation penetration would accelerate across Asia and really lead to a reduction in COVID restrictions as the economies around the region reopened. We also felt the pickup in economic activity would really benefit Asia, given its leverage to global trade and consumption. What we didn't anticipate was the emergence of the Delta variant, which really appeared in May, and of course the subsequent Omicron variant. Asia's approach to reopening, while still seeing infections circulating in the societies here, has been more cautious than we saw in the West. And we really witnessed, let's say, further delays to that reopening strategy, especially in China and Hong Kong, which continued with a zero COVID strategy. And now that delay in full reopening really caused Asia to lag developed markets this year. And then within Asia, towards the bottom of this page, we were right to be positive on India, but we really underestimated the full risk coming out of China in 2021 as the central government used essentially the air cover of global recovery to take a strict line on leverage, especially among real estate developers, and to introduce some pretty draconian rules around certain sectors. So we're going to cover that in some detail here. We also remain positive this year, and we still continue to do so on the themes across ESG, EVs, and all forms of clean energy here, et cetera, because we are in a sort of transition period for this part of the world. So what does that mean, and where does that leave us for the 2022 outlook? That we cover on the next slide, slide number 3. And here, in a nutshell, we've just basically pushed out the reopening call for Asian markets into 2022. What didn't happen in 2021, we definitely now expect to happen in 2022. Vaccination rates are high across Asia, at least developed Asia, China, etc. Singapore here, we're 87% vaccinated. In China, we're 85% vaccinated, and so on. And as long as those vaccines show to be, I think, at least reasonably effective against Omicron and new possible variants, we should continue on that path to a more comprehensive reopening here. Now, Singapore's already done this, remember, including allowing vaccinated people to travel. But it's really the Chinese border that remains closed without enduring long periods of quarantine. And that's unlikely to change until well after the Beijing Olympics is completed. In fact, perhaps that reopening in China happens in stages, and it may not even really commence until the second half of 2022, assuming, and it's a big assumption, that the kind of COVID concerns start to abate by then. But while we believe reopening will still happen, Asian governments are watching the US and European experience very closely, and if new strains don't overwhelm the medical infrastructure there, we think Asia will follow pretty quickly. And remember, fiscal and monetary tailwinds will fade away in 2022, but the recovery in demand and the dissipation of that economic slack will ultimately fill the gap. So we continue to remain positive on equity markets in our outlook for next year, although our multi-asset team has dialed back their overweight from max overweight, which they were at the beginning of this year, to a slightly more modest overweight equities for 2022. Although we also acknowledge they dialed up their exposure to Asia and global emerging markets, which is encouraging as well. So they also agree in our view of the delayed recovery starting to happen here. Now, remember that Fed tapering timeline will shift into higher gear this month, but that strong global recovery, we believe, should make that impact slightly less eventful than we saw way back in 2013, the last taper tantrum. The timing of the first rate hikes will to some extent be dependent on what happens to inflation data over the coming 6 or 12 months. but we're expecting 2, possibly 3 rate hikes in 2022. Now, the country that's clearly operating on a different cycle here, and Trisha's going to touch on this, is China. China went into the COVID pandemic early. It came out earlier than most countries. And in emerging, like everywhere, China was concerned about runaway asset prices, especially in real estate. And the government began a series of tightening measures, specifically targeting the property sector, which we're going to delve into. But that seems to have pulled back a little bit. So I think what we're looking for, China to engineer somewhat of a soft landing in the early part of first half of next year, on the back of the fact that maybe some of those tightening measures went too far and they were at risk at really slowing the economy too much. So looking into next year, we also continue to believe that ultra low interest rates and negative real rates in many jurisdictions will drive investors further out the risk curve, including to Asian bonds. In fairness, we said this last year too, but that trade was kind of derailed in 21 with the Chinese property developer crisis, and certainly the offshore bonds that they have the US dollar offshore bond market. But we did see very strong inflows into Chinese government, SOEs, and quasi-government bonds in the onshore bond market this year. And again, Trisha's going to touch on all of that. So just one final point that we're going to touch on with Sam is this idea that GEM is becoming very much dominated by China. And there is the potential and the discussion we're having with many of our largest institutional investors of carving China outside of a GEM portfolio. And mostly this is motivated by the sheer size of the Chinese exposure within GEM. But that could have ramifications for the other GEM markets. So what happened in Asian markets this year? On slide 4, as you can see, India was the star performer in Asia, in Asian equities. And despite having one of the lowest vaccination rates and one of the worst Delta variant outbreaks, the Delta was really a super spreader in India, but it faded quickly and it pushed the economic recovery to really an accelerated reopening over the summer. Within the rest of Asia, Japan also outperformed broader Asian ex-Japan indices. And the Asia ex-Japan markets were really held back by China tech, especially those huge platform companies like Alibaba and Tencent, as the government cracked down on their near monopoly tech positions. Now, Tencent's down about 18% year to date, and Alibaba around 45% year to date down. So those are such benchmark heavyweights, and they're almost alone responsible for China's negative return in 2021. Now, having said all of that, of course, markets are forward-looking. So what's the outlook for earnings in Asia and economic growth for 2022? We show that over on the next slide, slide number 5. And this slide really shows the levels of Asia economic growth, which remained above global rates of growth, as you probably would expect. And we expect that continue into 2022, although at a more moderate pace as we come down for our recovery highs. But we're probably still in most of Asia above their historical rates of growth. The exception here is China. And again, China had its own policies to try to deal with the property sector in the second half of this year, which probably knocked growth back too much. And that could take a little bit of time to unwind in the first half of next year. So we're looking at growth rates around 5.2, potentially a little higher if China takes its foot off the brake more than people expect in 2022. Now, within Asia, on the right-hand lower chart, you can see the EPS line for Asia ex-Japan region was relatively lower than the rest of the world in 21, but it actually stays about the same rate of growth for 2022, while the rest of the world declines for 2022 as their recoveries normalize. But remember, we haven't really had the chance to normalize yet because we haven't really fully reopened yet here in Asia. And some of the very strong figures you're seeing on that lower right-hand chart of EPS growth in the Philippines, Southeast Asian markets, etc., are really reflect the late bloom in that recovery cycle that those markets are experiencing. If we just turn on to the next slide, slide number 6, as I mentioned, the stricter lockdowns, they certainly had an impact on Asia's slightly disappointing, let's say, recovery this year. But of course, Xi Jinping's announcement of the Common Prosperity Model, targeting various sectors, but in particular the real estate sector, which this slide focuses on, was also a big factor for Asia performance this year. I'm not going to go through this slide in detail, but just try to imagine the government's really trying to address two key factors that prevent young couples, millennial couples in particular, in China from starting families. And namely, that's the cost of housing and the cost of education. And it's pretty clear that China's income equality has deteriorated for the past 2 decades. And this, like everywhere else, the government is probably looking to redress this balance over the next few years. So as the government looks to reduce this imbalance, they're also looking to reduce the systemic risk that the property sector could play in the broader financial system. So on slide number 7, we also focus on the Chinese government here. If they're focused on stability and the Common Prosperity Model, does this mean that the major growth drivers for things like urbanization or wealth creation, the growth of the middle class and so on, are they no longer valid in this operating model? And of course, we don't believe that to be true. This shows on the left-hand side China's urbanization ratio at just around 60%. Now, Korea, as an example, didn't stop developing in the 1980s just because it reached a 60% urbanized population, where China is now. In fact, their urbanization ratio continued well into the early 2000s and peaked out at around 80% or just over. That same pattern was exactly true for Taiwan as well. Why should China's experience be materially different? China does have a population that will soon start to age and a declining workforce, which again, we think is why the government's trying to tackle some of these big issues like housing affordability and family sizes. If we turn over to the next slide, China did rapidly curtail lending in the second half of 21, both on any kind of broad-based measure like total social financing we show here, or any other narrow measures, real estate loans, mortgage loans, and so on. And loans to developers and mortgage lending dropped significantly in the second half of the year, which really caused this cash crisis of sorts for developers like Evergrande and Kaisa, which hit the news over the last week. However, as I said before, it appears that the government's trying to rein back some of that aggressiveness around those and allow cash to flow back to the developers so they can finish projects and they don't deprive people who have put down payments on new units. And again, Trisha's going to spend a little more time diving into this area in more detail. The next slide is one of my favorite ones, and this is slide number 9. And we all know Asia as a major exporter of goods to the rest of the world. Now, Asia's done okay in the export recovery as the rest of the world has recovered. Unfortunately, due to these COVID patches around some ports and factories in China, the delayed reaction to the consumer stimulus perhaps that was injected into the US, Asia struggled to meet the demand of a lot of things, from bicycles to semiconductors. And of course, the logistics delays at US ports meant that containers piled up as they were offloaded. And this, we believe, this supply chain management issues, things in the wrong places, people in the wrong places, workers not fully engaged again. This has really caused this goods inflationary shock that we're seeing. And we do expect this pressure to moderate as the supply response takes hold. Again, if you look at the oil sector, we're starting to see signs of that as well. We also see anecdotal evidence that Asia is starting to spend on capital investment again for the first time in many years. You know, TSMC, the largest semiconductor in Taiwan, announced earlier this year that they would spend $28 billion in capex in 2021 versus $18 billion in 2020. Now, they haven't been able to deploy all that because of the hangover of COVID. But as I said, we do expect this capex cycle to ramp up, and it's really just been delayed a bit longer, and that's having a knock-on effect onto the supply chain issues. So again, you can see why we focus so much on real estate and whatnot, because on the right-hand side of the slide, while you saw the big recovery in Asia real investment growth, it also declined quite dramatically again. And that was really a function of the declining investment in China real estate. So China really is so big, it has the tendency to wash out a lot of the other data emerging from the rest of Asia. So the capex cycle, for example. And it's really almost swamping some of these other factors. So, but as I said, we do expect that to continue and to recover, and that pressure on the real estate side to abate. Quick wrap up on my last slide. We just wanted to show on slide number 10 on the factor performance across Asia, and this will lead in about 10 or 15 minutes into Sam's area nicely as well, because while 2020 was a momentum and growth market across the region, 2021 has really tended to favor the value and dividend income stocks on the lower chart here. We don't think that trend of the value and the cyclical recovery is over, given that kind of delayed response or delayed reaction I explained earlier. And given that Asia, especially Asia ex-China, is more biased to cyclicals and financials. So we think there's still more to play out here, and Sam's going to delve into that. So 2 seconds of recovery, or our summary, and then we're going to go into Asian fixed income. The summary really here to leave you with is Asia has experienced a kind of delayed reaction to this post-pandemic environment due to the slow reopening and Chinese specific policies. We think the post-pandemic reopening will happen, and that recovery in exports will really lead to a recovery in capital spending and capex that we're looking for across the region. We're still positive on Asian bonds, given their positive real yield in a fairly benign yield environment and negative yielding environment in many cases. And China is on a totally different policy cycle than the Fed, which could provide some interesting backdrop as the Fed starts to raise rates. China looks like they could be easing policy. And we think that institutional landscape could change a little bit this year within both the fixed income space in China and the equity space, as people look to carve China out or make dedicated allocations to China fixed income. This is a good segue to bring in my colleague, Tricia Wong from the Asia Fixed Income Desk here at Eastspring in Singapore. And Tricia, if you want to turn on your microphone, I'm going to pose the first question. You've brought some really interesting charts with you here that we want to dive into. You have some additional information to share on the macro drop for Asian bonds that you guys look at on the fixed income desk. Why don't you lead into those? And I've got one very specific question for you I want to see if you can address, which is Asian markets, are they still taking their cue from the Fed policy direction, or are they increasingly looking to China, given it's a large part of their trade basket? Over to you, Tricia.
Sure. Maybe we can go to the next slide. I think broadly for the fixed income team at Eastspring Investments, we agree with the point that you earlier highlighted, that Asian economies appear to be on a firmer footing than much of 2021. This is, of course, helped by the improving COVID situation, which allows mobility restrictions to be relaxed in countries like India, Indonesia, the Philippines, and Thailand. So this has helped restart manufacturing activities in these countries, and the resilient demand from the developed markets has also supported new export orders, as you will see on the left-hand side chart here. So we think growth should continue to hold up in the coming year for some of the reasons you have already highlighted. But I think a key difference between Asia and the developed market is that the region is arguably at an earlier stage of recovery than the US. And the fiscal stimulus during the COVID pandemic has been a lot more targeted in the region. We've seen like debt moratoriums and wage subsidies, while in the US, money has been put directly into pockets of household. So I think all this suggests that, there's less of a pricing pressure in Asia that's associated with an exceptional rebound in domestic consumption, like what we saw in the US. This is particularly so because labor market in the region remains, that there still remains a slack in the region. So I think, that there's less of a pressure from wage increases, and that could actually spill over to pricing, consumer prices. So this is why we think inflationary pressures in the region are likely to remain more benign than, say, in the US. Of course, we do note that China will remain the outlier. China has been the first globally to the COVID crisis, and growth, like you pointed out, has slowed significantly due to the regulatory crackdowns, including in the prop sector. So analysts are now expecting growth in the country to come in near 5% or below 5% next year. Having said, I mean, for us, we do not expect a hard landing in China that will derail Asia's recovery in 2021. This is because now the Chinese government has acknowledged challenges it can be seen in some of the speeches that are made by the officials. And the central bank has also turned more accommodative. The government is in general to be more willing to turn on the fiscal and monetary policy support. Of course, we've seen recently how PBOC has just cut the reserve requirement ratio for banks for the second time this year by 50 basis points. In the coming year, we could see more. We are also seeing incremental easing of property restrictions. For example, the banks have the PBOC have actually asked to accelerate mortgage approvals so that the funds could be distributed to property developers sooner, and more fiscal support could also come in the form of infrastructure spending. So what all this means is that, while the Fed rate rises would still some impact on Asian domestic rates, because historically that there's some influence on the Asian interest rates because of how interconnected the economies are, as well as some economies are more sensitive to US interest rates historically than others, which may be more on domestic consumption. But having said that, the uneven growth momentum in the region and the nascent domestic consumption recovery region will still mean that Asian banks in general can afford to be more patient than the US raising rates, with probably the exception of Korea and Singapore, which have already begun their tightening cycle. So all in all, the extent of interest rate rises in Asia to be more muted, and in some Asian countries even, central banks actually have the room to keep policy rates unchanged for next year. These countries which we expect would be like Thailand and Indonesia. And of course, in China, we are expecting further monetary policy easing, although maybe they might not actually resort to interest rate cuts. They could do it through other tools such as reserve requirement ratios, through some other influencing the bank's lending rates lower. So this combination of the growth recovery in Asia and the overall benign interest rate environment, or relatively benign interest rate environment in Asia, should still provide a generally supportive backdrop for Asian bonds to develop market bonds. And to your question on whether Asia will look to more the US or China in terms of setting the monetary policy direction, I would say that it will be a combination of influence on the external interest rates, like what the Fed's move, as well as what is happening domestically. So it's not only about the Fed, definitely.
Great, thank you. That's a very comprehensive answer, Tricia. Now, of course, everybody knows the big story in Asia credit over the last few months has been the rapid widening spreads on China's US dollar offshore high yield bonds, especially those focused in the real estate space. But the growth of the domestic bond market has also been significant this year. Are the credits behaving the same in the domestic market as they are in the offshore market? I think you've got a really interesting slide on this.
Yeah, so if we actually can look at the next slide. So this would show you the performance of the China corporate bond market on the left-hand side chart here, and also the Asian dollar bond market on the right-hand side chart here. So the Asian dollar bond market would also include China dollar bonds, and is a significant part of the Asian dollar bond market. So from here, you can see that there's actually a divergence in terms of performance. And I think it is, first of all, it's important for us to understand that the profile of issuers in the China onshore bond market versus offshore dollar bond market is vastly different. So in the China onshore corporate bond, it is dominated by China's state-owned enterprises, and local government financing vehicles as issuers. Real estate companies represent less than 5% of the onshore bond market. In the offshore bond market, it's different. Real estate sector represents around 18% of the dollar bond market, 58% of the China dollar high yield bond market. So China real estate issuers is a significant part of the dollar bond market, especially the high yield bond market. So the reason why the profile of issuers is so different is that historically in China, property developers were not allowed to borrow onshore to buy land. So that has actually pushed a lot of developers to issue bonds to raise funding and acquisition activities. And as such, you will see from the slide here, why the performance of the China onshore bond market has not been significantly impacted turmoil in the China property sector, which you highlighted. Overall, China corporate bonds have in fact risen by 1.4%. And in contrast, China dollar property bonds have gone down by almost 30%. So this contributed to the declines in the Asian dollar bond space, which you'll see on the right-hand side chart here, where the Asian high yield bond market has fallen by almost 11%. But I have to say that outside of the China property sector, both the China onshore and dollar sectors have actually been relatively resilient. So if you look at the quasi-sovereign sectors, if you look at oil and gas, metals and mining, or TMT for that matter, the performance have been a lot more resilient than the steep declines we saw in the property bond market. And China onshore bonds in particular have also benefited from the lower domestic interest rates in China this year. So given the central bank's shift towards a more accommodative bias, so that explains the divergence in performance.
Okay, now you're dropping in and out a little bit, Tricia. I'm not sure if other people are picking that up, but try to speak a little closer to the mic or something like that. I'm not sure if it's just a bandwidth issue here, but anyway, we certainly get the gist of what you're saying. You have some very specific default data, I think, on the next slide, and defaults and debt exchanges. What's the difference between this and China, and how far are we, let's say, in working through this restructuring of China's most vulnerable property companies?
So the reason why we have actually put this default information here is to really show how challenging the China property market has been over the past year. So this year we saw more than 10 property issuers defaulting, if you want to include Evergrande and Kaiser. This compares to just 4 in the previous year and none in the year before. Also, it's very clear that the operating environment for property issuers have changed significantly this year, and this is largely induced by the tightening of financing rules by the Chinese government. So apart from implementing the 3 red line policy, there have also been scrutiny on how these property issuers are issuing proceeds from property pre-sales. In addition to that, off-balance sheet funding channels have also been tightened. So that really squeezed the liquidity positions of these property issuers. So in light of all these developments, it's also clear to us that it's not enough to monitor property issuers based only on credit ratios that are published in statements. In fact, a number of these defaults that occurred, right, are in companies that are not in the red camp of the 3 red line policy, meaning they have not breached all 3 credit ratios that are set by the Chinese government, and those which appear to have sufficient unrestricted cash balances have also surprised the markets with default. So in consideration, taking into consideration that in navigating the market, we are monitoring closely the different avenues of news, such as including the onshore market chatters about which companies have difficulties paying shore liabilities, or which are the ones which have easier funding access onshore. So which are the ones that investors like. We also pay attention to companies' upcoming maturities in the next 3 to 6 months, and the made in trying to raise funding to meet these maturities, whether they're doing enough asset disposals, shareholder capital injection, or share placement, because this is clear that liquidity condition in the sector will remain tight for the next 3 to 6 months until the effect of the policy easing is being felt more broadly in the sector. And in the meantime, some of these issuers will continue to be shut out from the offshore bond market, which closes an avenue of fundraising for them. So it is very critical on how they are actually withiness in liquidity condition in the next 3 to 6 months, which is why I know we are paying close attention to what they're doing right now to raise these funds. I hope you can hear me more clearly this time.
Yeah. It's I got it. It's the next 3 to 6 months are going to be critical, right? In terms of now, you talk about the bifurcation between the onshore bond market, and the offshore bond market that's taken place. And to some extent, this is a function of the different exposures in the different markets. Is there a different impression of risk in the different markets? Is the onshore market more correct of their risk assessments of China than the offshore market, or vice versa? How do you see this playing out between onshore and offshore?
Okay, I mean, look at the default rate chart in slide.
Next slide.
Oh, this one.
Yeah, so I think this slide would impression that onshore market seems to be more stable, having less default rate, whereas the offshore market seems to have increasing default rate. So again, there's the bifurcation in terms of default rate, but it's not really a matter of whether onshore investors are more right, or offshore investors are more right in kind of um, uh, identifying which companies would default, or whether the credit quality in the offshore market is worse than onshore market. I think a key difference in the default rate between onshore versus offshore China bond market has really been driven by the difference in issuer profile, which I've actually explained earlier. The onshore bond market has lower proportion of real estate issuers, which has really been the epicenter of the default this year, while the size of onshore corporate bond market is also larger compared to the dollar bond market, given that onshore bond market size is 3 trillion compared to the dollar bond market size of 600 billion. So naturally, the rising defaults in the property sector becomes more magnified as a percentage of total market size in the offshore market than in the onshore. But there can also be differences in terms of how onshore and offshore investors perceive the credit quality of issuers. So in general, onshore investors, they have generally more diverse local information, and they have deeper understanding of local practices, such as the use of off-balance sheet financing by property developers. So this is something that a lot of offshore investors are not aware, or are not paying enough attention to, until this wave of defaults actually hit the sector. So generally, onshore investors do have the information advantage compared to the offshore offshore investors, and we've actually seen real examples of how offshore investors eventually had to converge to onshore views. So this is also a thing that is very important to have onshore research capabilities, like what Eastspring has. But it doesn't mean that onshore investors are always right, of course. For example, last year, onshore investors were also taken by surprise by the default of a local government-linked company, Yongchen Co., which is rated triple A onshore. And that led to a sell-off in other local government-linked bonds. There were also cases when onshore investors sold down positions in issuers which offshore investors like, but the bond prices eventually recovered, such as of Beijing Automotive. So what it really boils down to the importance of doing your own proprietary research only is helpful to take into account both the onshore of things.
I just want to leave enough time for Sam. So just in the last 30 seconds, I want you to show the last slide you have, because again, this is fascinating. The correlation difference between the onshore bond market and the offshore bond market with other global bond markets in particular, but also global equities you have up here, is starkly different. Walk us through this if you can, just in 30 seconds here.
Yeah, so I think the low correlation of China onshore bonds compared to of the world is really driven by the country's unique economic structure, as well as their policy stance, which is often counter-cyclical to the rest of the world. So for example, China has tightened financial conditions since second half of 2020, but this year, while most countries are talking about tightening, China is looking to ease policies. So that's why this year we saw 10-year US Treasury yields rising by 50 points, but year to date, the 10 years Chinese government bond yields have fallen more than 20 basis points, even as foreign investments rise in the China bond. So I think China's very independent policy cycles are underpinned by the very controlled capital structure. Increasingly, its reliance on domestic demand and its longer term national agendas. So that have been kind of like a between China policies compared to other countries. So it's also driven the low question in terms of bond performance compared to the rest of the world.
Great. Thank you so much, Tricia. Stick around for the Q&A if you can, just in case we get any questions to follow on from this. But it's a really fascinating area, and I think the fact that the market has such low correlations, the domestic bond market, the onshore bond market, does make it attractive for a lot of foreign investors, actually. Now I'm going to turn over to my colleague Sam Bentley. He's been kind enough to dial in from the UK, where he's on a family holiday. So thank you for taking time out of your holiday, Sam. Normally you're based here in Singapore. I just had to explain why it's light in your back window and it's going to be dark in all of our back windows. So because you're in the UK. Now, Sam, just to kick it off, I talked about the dispersion of returns across markets broadly during my introduction. I think you've broken this down even further with the EM. Take us through that if you can. And there's some surprising divergences here where some commodity markets did well, some did poorly, some tech markets did well, some did poorly. What have you observed?
Yeah, thank you, Adam. Yeah, absolutely. I think so. On my sort of second slide, we've sort of broken down the emerging markets performance for the year to date, the end of October. And yeah, I think it's been a really interesting year for equity markets globally. And you can just see here we've sort of flagged some of that huge dispersion that we've seen. In the first sort of green box, you can see from a regional perspective, while emerging markets as a whole were flat broadly, you can see how much dispersion has been. EMEA up significantly, with Asia and LATAM behind. And then, from a style perspective, and Adam touched on this earlier, it was a great year for value, and not such a great year for growth. So value was really the place to be over the year. And within those regions, EM Asia, the big dispersion we sort of touched on earlier, India up so strongly versus China, and in EMEA you can see and LATAM some more dispersion. I think so. A couple of the interesting ones when we think about sort of historically, people think of emerging markets as big commodity plays, and historically many of the markets driven by commodities. You can see that to those traditional players, Brazil and Russia, having very different experiences in 2021, and there was a lot going on behind that sort of commodity story on top of that commodity story that we saw. Well, in Russia, had that some commodity tailwinds, but also its financial sector was benefiting from that as well. So quite a few financial stocks in there doing well for the year. Brazil had quite a few problems. So despite some commodity tailwinds, there's been concerns around Brazil's fiscal discipline. They're seeing inflation come back very strongly. Exchange rate has been very weak. And there's concerns around interest rates as well. So Brazil had they both had some of these commodity tailwinds as a starting point. They both have very different outcomes over the year. Similarly, in the sort of within Asia, we see traditionally, Korea and Taiwan, two tech-heavy countries, having very different experiences as well. Korea sort of had strong tailwinds from its IT sector, more in the hardware space. but it had a very strong headwind from the headwind from the pharma sector. So actually, it ended up not doing so well. Whereas the Taiwan didn't have that headwind from, and so it had strong tech, strong financials, and so it did pretty well over the period. So all of this really for us just flags again the importance of being active in equities, active in emerging markets, and particularly over the last year. Obviously, it's been a good place for value investing. As Adam alluded to earlier, some of the delayed sort of tailwinds, some of that stimulus starting to only now to feed through into many of these emerging markets, and so we think there's lots of interesting opportunities out there.
And that's a perfect segue, as you being part of the Global Emerging Markets equity team here at Eastspring. Many investors think of GEM in Asia as being all about growth, and we look at long-term performance. Growth has done well over the last decade, but if you go further back, back 2 decades, value really outperformed. Take us through that growth value debate for GEM and remind us again why value might look attractive now relative to growth.
Yeah, so I think as you said, over the last 10 years post GFC, value hasn't had such a great time, and I'll come back to that. But over the longer term, over the last 20 years, value as a style, as shown on the left-hand chart here, that red line has actually outperformed other styles. Now, fundamentally, we believe that paying a discounted price for an asset, for a decent quality asset, is going to give you a tailwind for your investments over the long term. Ignoring the valuation you pay, ignoring the price you pay, paying too much for growth or quality characteristics over the long term can be detrimental to performance. So we're very much of the belief that value does work, and we've seen that over the very long term it does. What we've seen post GFC was where investors stayed invested in emerging markets. They had a preference for growth and quality once more because they'd been burnt by the GFC experience, and so they've in a very low interest rate environment, this supported growth and quality stocks at the expense of value. This was exacerbated in the early stages of COVID outbreak of early last year. But since September of 2020, when we saw the stimulus come out, when we saw vaccine rollouts put in place, we've seen a reversal of that, and investors have started looking for value opportunities, and we've seen that's really what's driven sort of that tailwind for value, particularly in some of those cyclical sectors. But what this this last 10-year headwind has done for value in terms of the relative valuation of the different styles on the right-hand side, here we're showing you the valuation differential between growth stocks and value stocks using a PE metric. Now you can see here that over the last 10 years, this gap, the differential has got wider and wider until we're sort of what's a really extreme level. So what this is saying is that growth stocks have become extremely expensive relative to value stocks, or value stocks are extremely attractive and relative to growth stocks over the long term. And we've got the same chart for quality stocks as well versus value. So it's basically the sentiment, the emotion that's driven investors over the last 10 years has got us to a very extreme position, which we believe reflects a pretty interesting opportunity for the near term if you can be sort of active and selective around which value stocks you can pick up.
I think we're going to cycle back to that point at the very last question. But in the meantime, I want to pick up on this idea because, again, I find it fascinating. On one hand, in the bond market, the Chinese bond market has become too big to ignore. On the other hand, the Chinese equity market has become too big, let's call it, for its own bedfellows. It's now really starting to eclipse many of the other global emerging markets. And you've had so many conversations with our institutional clients about potentially carving China out of the GEM universe. As I said, several reasons to do this. One might be the size. One might be a style works better in one segment of the market versus the other. And one might be, for politics or ESG reasons or something as well. But I think your team has done a lot of work here on this, and even recently launched a GEM X China value strategy. Take us through why somebody would allocate separately to global emerging markets universe, excluding China, and then China separately.
Yeah, sure. So on this first slide here, I've got a few slides just to take through some of the key, I guess, arguments for this. Yeah, we've had a lot more questions from clients, particularly given what's been going on in China over the last 12 months, but also just more broadly over the last, as we're showing here, over the last sort of 20 years. If you go back 20 years, emerging markets are very much dominated by LATAM and EMEA. The big players, the Brazils, the Russias we touched on earlier, and Russia was really only around. Sorry, China was only around 5% of the market. So Asia as a whole wasn't the dominant force in global emerging markets, and nor was China. But as we've seen over the last 20 years, China's sort of economy and market size grow. It's become incredibly dominant. So we're now seeing that China, quite recently, was 40% of the index. It's come back a little bit more recently with underperformance, but it's now become a very heavily dominated, China-dominated market in broad emerging markets. Now, the first challenge for that is that because when investors are allocating to this space now, they're taking a big call on China, and they're embedding that in their emerging market call. So from a starting point, you're saying, okay, well, emerging markets is really a China plus call. And so that it all gets wrapped into that one investment decision, and the correlation of your emerging market decision with a pure China decision is very high. So it's become one and the same, and so investors started thinking about, okay, so is China now so big that I should be allocating it to it separately? On the next slide, we've got a couple of another way of looking at this, which just shows you the market capitalization of some of the big markets in the world. So this sort of, I guess, if we think back again, a lot of years back, we had Japan being wrapped into the Asia index. Once it became large enough, people started to separately allocate to Japan. China is now already much larger than Japan in terms of market capitalization, and so it justifies itself from that perspective in terms of a market size and opportunity set and opportunity size. And we think that maybe that that on its own sort of shows you that it could be an interesting opportunity. Now, so removing China on the next slide, if we think about what does this do to sort of the opportunity set as well, if we think about from an active management perspective, you think about how many stocks there are in the emerging market index. There's 1,400 stocks, just over that at the moment, but of those, over 750 of those are Chinese. So China is heavily dominating that space, and what it does, it tends to crowd out the rest of the index. So as an active manager, you're looking at the universe, you're trying to get the best ideas in this universe. Obviously, you're going to be heavily dominated by China, even with sort of a completely benchmark agnostic approach. If you remove China on the right-hand side, or we remove China, so this is the MSCI Emerging Market ex-China index, you can see we're now down still to a decent size index, 680 odd stocks. So it's still a very large universe to select from, very liquid universe. But what's interesting for us is that you start to see some of the interesting countries down the bottom there in terms of smaller sizes, Poland, Qatar, Chile, Philippines, getting more attention. And there are some great stocks there that in the broader benchmark wouldn't necessarily be given much attention just because China's effectively crowding out that market. So, we think there is an argument to be made. You can take a dedicated China allocation, China AH all share manager, plus your EM ex China manager, and you can try and capture the very best of both of alpha opportunity sets.
Great, and it's so important, exactly. And one style, growth style, may work particularly well in China. Value style may work better in Gem X China. The timing of the trade into value can be tricky. Again, going back to that sort of flip-flop we saw between growth and value over the last 2 decades. Are we at another inflection point? I mean, it fits so nicely, doesn't it? Maybe almost too nicely, but 2000 to 2010 was a value market. 2011 to 2021 was a growth market. Are we about to hit that catalyst or that inflection point where value would be the one to favor going forward?
Yes, I think I think there are lots of arguments for that. On the left-hand side here, we're showing you that the emerging markets as a whole have been looking cheap relative to developed markets. And if you can think broadly speaking, developed markets may be a higher quality sort of market to the emerging markets, and that sort of quality bias has led people into developed markets, which is particularly the US market. And that's now, you can see, just become even more expensive. So on the left-hand side, we're showing you that emerging markets in a relative sense to developed markets are still looking very cheap, and in fact, just recently got even cheaper. So we think there's a very interesting valuation tailwind. But more interesting for us on the right-hand side chart is that within emerging markets, we touched on a bit before, there's this huge gap between the cheap and the expensive end of the market. Now, this chart is just showing you the gap between the top 20% average valuation of the top 20% of the market versus the average valuation of the bottom 20% of the market. So this is telling you that the cheapest stocks are very, very cheap compared to the expensive stocks, or the expensive stocks are very, very expensive relative to the cheap stocks. There's a huge difference right now.
Is that three standard deviations?
That's a 3 standard deviation event. So this is a once in sort of 2 decades, once in a lifetime type event that, it is really just, it's off the charts. And this is really being driven by some of those expensive e-commerce type stocks that we've seen falling from grace a bit, as Adam touched on earlier. But they're still very expensive parts of the market that have been bid up very, very high. So that's from a valuation tailwind sort of perspective. Your growth and quality stocks have got to perform almost to perfection from here to deliver on their expectations, given this kind of valuation that people are paying for them. On the other side, from a value perspective, we think that you've got a backdrop of this incredible sort of stimulus flow through, particularly investment in infrastructure, the real economy type sectors, there's cyclical type sectors. There's this build up in consumption, which we think can again benefit the real economy sectors. And whereas the previous decade, that 2010 to 2020, was all about the sort of internet revolution, digitization, we now believe we're moving more into a focus on decarbonization decade. So a lot of investment going forward is going to be in physical infrastructure, real infrastructure, decarbonizing the global economy, and all of these factors are supportive of value. So we've got the valuation tailwind plus a lot of these other stimulus factors that we believe are lined up. So we do believe that there's a pretty strong argument right now for this sort of active approach to emerging markets and particularly in the value space.
Great. Thank you so much, Sam. I think we're going to leave it there. I know we only have a few minutes left, but I wanted to turn it over to Alicia again to see if there's any questions for Sam or Tricia or myself.
Thank you. Yeah, thank you very much. Actually, we do have some questions. So very, very quickly, maybe going back to Tricia, we have questions about Chinese banks and how are them affected by the real estate crisis from a credit perspective.
Yeah, so I think this is that this actually the concern is really about the contagion impacts from the turmoil in the property sector. But I guess a key thing to note is that this property measures tightening has not actually happened overnight. So I think this is something that the EOC, the Chinese police have kind of flagged up to banks. They asked them to do stress testing, and they've actually limited the loans that they are issuing to property companies. So all these measures have actually helped limit risk exposure Chinese banks to the property sector. So I think there was also a study that was done I think last year, about and that actually includes a testing, if let's say the non-performing loans, the sector actually has gone up, whether they have still sufficient capital buffers due to the rise in non-performing loans. I think that the stress test results has come up to be quite satisfactory. There was actually a 15% non-loans. It does seem that the banks still have sufficient capital.
Okay, thank you very much.
Buffers.
we're having some problems with your connection, Tricia, so I'm going to jump into another question for Sam, and it's about the rising US dollar on local currencies in emerging markets in Asia. What would be the effect going forward?
Yeah, so I think it's a pretty stock specific or country specific issue. I think Tricia touched a little bit on terms of interest rates, directions, and interest opportunities of interest rate paths, which obviously has an influence on exchange rates. The way that we tend to think about it is a lot about what is the impact of that exchange rate on the specific company's earnings. What are the sensitivities to that specific country's earnings from the change in exchange rates? We don't have a strong view on the direction of interest rates from here. But we tend to, as I said, test sensitivity. We don't think that there's going to be significant exchange rate volatility from here. So we're relatively comfortable with that. But where we do see some within the emerging market space, where we do see some exchange rate volatility, we tend to prefer companies that have natural hedges built into their earning streams. So they have maybe domestic and offshore earning streams, which can really neutralize those kinds of risks. When we look at our portfolios, it tends to be the stock-specific risks that drive our outcomes, and actually, the currency impacts tend to end up neutralizing each other because there's such a dispersion of currency volatilities that across a diversified portfolio, you tend to hedge your own currency risk away, and it tends to be less of a concern for us at a portfolio level.
Okay, thank you very much. So I think we're out of time for any further questions, but I want to thank all of our panelists. I also want to thank Matthew. I don't know if he's around or he's not with us anymore. Oh, there you are, Matthew.
I'm still here.
Thank you very much. Thank you, Eastspring, for being with us once more, and thank you to our audience. And before we all leave, I just want to say happy holidays. We have a very, very short video for you with the best moments or the virtual investment summits in 2021. So I just want to leave you with that, thanking you all again.